I've been a paying subscriber to Moses's newsletter, Random Walk, for probably 2 or 3 years now. I think he's a really, really sharp guy who writes about markets and the economy and business generally with a real eye towards data. I think he has a lot of fun sort of poking holes in narratives. And we sat down and talked through some of the ideas that I've been working on around SMBs and real world companies. And Moses is always a good time because he is very, very quick to call bullshit on anything that feels like, too self-aggrandizing. So this is fun because it keeps me honest.
All right, so you kind of had put a couple of things to me that I thought would maybe be like interesting things to talk through. So one is like market size and fragmentation. Like, can you really build businesses here? The second is, what are like the real barriers or blockers to SMB owners? And then the third was, how do you qualify these companies at pre-seed / pre-revenue? Like, does the founder have to know the problem firsthand, have a clear path to overcoming the fragmentation problem, something else? So maybe a good way to start is just like, I can kind of give you a take here on, I do really think that the founder profile that makes sense today is changing, and that as we see simultaneously like the opportunities for pure software businesses kind of shrinking and getting competed to death and TAM constrained and feeling shakier and shakier, businesses are moving into sort of more complex compound business models and often in more sort of service-oriented categories. I do really think that has big implications for who should be starting companies and who will run them well. So obviously being technical matters a lot, shipping fast matters a lot, but those qualities can kind of run up into a brick wall once you're dealing with the real world and with, sort of under-resourced or unsophisticated, at least technologically unsophisticated customers. I do think that the ideal founder for kind of these SMB oriented companies or these real world oriented companies is really, really different. When we look at the founders who we've backed to do stuff like this, almost universally, every single one of them has either founded and run a business beforehand. They are much more experienced in dealing with sort of operating a company. And many of those are sort of real world oriented businesses. So we do really see this as a place where like experience counts when you're shipping stuff to the real world, whether it's building physical companies or doing physical operations or helping orchestrate physical operations. I do think that you can't just ship a quick fix. You have to kind of get it right. If not the first time, then on the N-1 time instead of the N+1 time. And that really changes how you build and run these companies and who builds and runs them well. Does that pass muster for you?
Yeah, to some extent. I mean, I'm a little curious. Like, it's and maybe I'm joining too many things, but I know you guys like you have this, the slogan "AI is not your moat," which I kind of understand to be like software is not your moat in some ways. Maybe I'm misinterpreting that. So it's like, what is the founder right to win here, and how are you gonna, identify it at such an early stage? If partly like when I hear real businesses in the real world, I mean, the natural instinct is, you think private equity, right?
Yeah.
But this is in some ways like one derivative removed from that, right? Like these are in some ways this is like a venture wrapper for private equity guys or something like that.
Look, I think that private equity is really good at a lot of things. One of the things that they're really bad at is understanding product. Private equity understands software. They understand how to underwrite software. They understand how to run software companies. I don't think that private equity is very sophisticated at thinking about the like value proposition of those end products. Like, what's the point? They're great at being financial stewards for those companies. They're not great at being, leaders of those products and nor even customers of those products. So there is definitely some fuzzing of the lines going on. For us, we just increasingly think that we want to have more tools in our tool belt, that there's a lot of different kinds of businesses to build on the back of, differentiated, valuable products. Sometimes that's going to be selling a product to industry. Sometimes that's going to be selling sort of a product plus, some kind of services or lead gen to industry. Sometimes it's building something natively from scratch. And as you alluded to, sometimes it's outright buying things and running them ourselves. But it all starts from the same key insight around, or key understanding around build something that matters, build something that changes economics. And we just have a much wider scope around how to capture the value once created.
But to be clear, like this is still you're still investing in venture scale businesses that themselves serve non-venture scale businesses, right? Like in other words, the SMB hypothesis is you're not betting on the SMBs
Correct.
directly. Right. So that
we're making a derivative bet on the SMBs, but I do think it changes the nature of how that derivative company has to be very different. When you're selling software to software companies and your end customers are, Fortune 500, Fortune 100 businesses, you run and build in a very different way than when your end customer is, pizza shops or plumbers or independent accountants. The physics of the business are meaningfully different. And I think how you go to market, how you think about product, how you think about customer service are all really different.
So in some ways it's like, all right, so to even taking a step back, so it's some version of this, you have this kind of ontology, right? Like there are a few different versions of them. I'm trying to remember them off the top. One of them is like tools. Another one is, I think I wrote them down. One of them is orchestration. One of them is tools. One of them is like biz in a box.
Yeah.
Why don't you dig into that a little bit more? Because I kind of have some questions about each.
Yeah. So obviously there's a long history of vertical software and like discrete tools, I don't think that those things are bad by any means. I think it's worth acknowledging that they leave something on the table. It is much harder to, those businesses don't get to the same scale, or it's harder to get them to the same scale. They don't have moats generally in a world where like software is not a moat. Well, what is a moat? The easiest and best moat for a software driven business is network effects. So how do we reorient those businesses to be more network effects driven? Well, they need to get into orchestration. So whether it's, customers or vendors or something else, like how do you simultaneously build a better, more defensible business for yourself through network effects and also build something that can deliver the benefits of scale to non-scaled players? And that's through orchestration and aggregation.
So like, why does that succeed now where other vertical SaaS has previously failed? Or maybe vertical SaaS hasn't previously failed. I'm just wrong about that.
I mean, the history of vertical SaaS is kind of mixed. There are a lot of really great mid-market companies. I think that people took some kind of bad lessons from basically point of sales businesses like, Toast and Square and said, I'm going to do this for that. I'm going to be I'm going to be Toast for X or Square for Y. And the problem is most markets just don't support that. The markets are too small. The monetization is too thin. Those are businesses that monetize at 1%, 2%, 3% of the gross receipts of their customers. So you have to be in like multi-$100 billion categories just to even sniff at having like, $1 billion outcome. And so how do you do something that is like more differentiated, will stand out in the crowd better, and can monetize better? I think you have to get much deeper into those businesses and into your customers and into those categories, and do stuff beyond, system of record and workflow optimization and payment acceptance. I think you have to get into the guts of the businesses, and that will often look more like some kind of orchestration. I've been really excited about group purchasing. I'm really excited about, some kind of like group selling. We have businesses that basically they're sort of like marketplaces, but really what they do is they sit between tons of small businesses and then the really big enterprises. And those small businesses go and sell collectively. So they join big contracts together to go and win deals that they would never otherwise win. That is an instance where we're basically replacing a single large, corporation with software. We're moving to a much more decentralized way of doing business. So is that like decentralized, not crypto, but not necessarily not.
Is that like a kind of business that is, like a category of business or intermediation that doesn't yet exist? Like what are examples of some of that? Like where you're kind of like pooling resources to get like where the transaction costs of orchestration would have previously been too high, but now all of a sudden they're possible And so all of these industries are going to now orchestrate together more.
Sure. I'll give you real examples of these. I think nothing is new. There are examples of this all the time. So in healthcare, we have the idea of like IPAs or independent physician associations or, various kinds of managed services groups that basically go and take lots of small healthcare providers and without owning them, negotiate collectively with insurance companies. That's a business model that is awesome and helps preserve clinician independence. You have, we are investors in a business that's going and doing something kind of similar in restaurant repair and maintenance. They go and contract with big chains and that for whom it's normally only economical to deal with really big private equity owned service providers. Instead, they're signing one contract that represents tons of different supply, and our business, sort of halfway between a software company and a marketplace and a services provider, goes and orchestrates the fulfillment. We have another business doing almost the exact same thing for industrial equipment. Coordinating in that case, it's not even between small companies, it's really between individuals and large construction companies.
So what's an example? How does that work? What do you mean? So what do you mean?
So a construction company signs a contract, a preventive maintenance contract, for instance. They just need, hey, I need my tires rotated. I need my, oil changed, whatever. And I just need it to happen. And instead of signing a contract with, the big business, the dealer, which basically is a local monopoly, they now can sign that same contract with like this intermediary representing tons of independent techs. Those independent techs are doing the preventive maintenance, but they're also doing the acute maintenance. There's a single point of contact and a single point of entry to transact. Now it's efficient to transact through the whole network rather than needing to say, hey, I'm a big company. I can only do business with big companies because it's not efficient for me to maintain all these relationships. And that is,
so it gives you the benefits of scale while maintaining independence. Interesting. Yeah. I guess I could see why, right? I guess, some of the existing industry participants would probably push back against that because then they won't be able to sell their relative scale as quite as easily.
Yes.
That's interesting. What about, so there's like a whole appendix on like embedded solutions, which I again understand. Yeah. Why don't you dig into that a little bit? Just because embedded has been popular for a while and trying to understand why. Yeah.
Embedded has been really popular for a while, in no small part because, as Stripe was really starting to rip, 5-6 years ago, everyone wanted to be Stripe for X. And it led to this proliferation of basically like fintech middleware companies. I'm going to be the connective tissue between you and some like big financial institution or consortium of financial institutions and let you like interact with that more easily. By default, I'm like pretty skeptical of those businesses. I think in part because they are a derivative of vertical software. And I just don't think a lot of vertical software companies, at least over the last decade, were really like set up to thrive and be, long-standing going concerns. They were built for scale that their markets wouldn't actually accommodate rather than like shooting for middle or lower middle market outcomes. I think one thing that's maybe happened a little bit differently over the last couple of years is we're starting to see more of the vertical software companies use a lot of new AI tooling to get up and running much more cheaply and stay off of the capital treadmill. So basically building in a much more realistic way. I think that opens up the aperture for what the embedded players can actually do. And I think we're starting to see kind of the idea of what vertical software is expand out dramatically. So it's not just, I'm going to be Toast for X, maybe it'll be big, maybe it'll be small, but it's now also, I'm going to be a business in a box company that's also building vertical software. I'm going to be a franchisor that's also building vertical software. I'm a roll-up, whether PE, VC backed or something else, that's also building vertical software. All of that collectively means that there's just so many more places like vertical software. There's so many more business model wrappers for vertical SaaS, which then means there's so many more places that you can actually embed this. The problem historically is that there's only so many of these companies that are going to really like exist and be at scale. And so you're going to get to a point where all of your customers have either gone out of business themselves, or they're going to just, cram you on margins, which is what's happened, for instance, with like Marqeta, where Marqeta does not trade very well because they basically have one customer that controls all the leverage in that relationship. Something like 80% of the business is Cash App. That is not an awesome place to build a huge company.
Why did that happen?
Because how many other card businesses really got to any meaningful scale?
I don't know. I feel like everybody's
there's a 20 scaled customer. Like, I'm sure that Marqeta, the number of names that they have, I'm sure they have 100 or 200 or 300 customers. The problem is they're in a category where their customers are power law distributed. It's awesome. They caught a whale. That's great. It's a lot better than not doing it. That losing 80% of your revenue would suck. But there's only like probably 20 or 30 customers, period, that operate anywhere near that scale. And so that is a really hard way to build, or that at least has been a really hard way to build a business. So, what would be the products that are both potentially more ubiquitous and will exist within every platform, or should exist within every platform? And, and how do you get, and will be harder to rip and replace? I think the challenge in something like cards is that it seems like quite a commodity now in retrospect. And there are a bunch of card issuers.
So why does this fail? Like what is it? What's possible that what's the thing two or three things that you're getting wrong potentially?
Yeah. Okay. Why does it fail? You mean the whole thing or the embedded piece of it specifically?
The whole thing. Like what keeps you up at night about something like this?
So I think you can be totally right on. Look, the biggest beneficiary of all of this is going to be Stripe. Unsaid is that basically every single company I've mentioned runs on Stripe in one way or another. And so there's a real possibility that like this is awesome for the small businesses, and this is awesome for like the real kind of indexed bet, that you make as something like a Stripe, or maybe some of the like real kind of deeper infrastructure businesses, maybe like a benefits player or something like that. That's really queued up to deal with small businesses, and that everything in the middle is just such a random walk around category selection and execution and market size. I think that is, so you can be totally right on history and wrong on the trade. I think that's
in some ways it's like you have
one.
to find those things that are mission critical to enough businesses where you have enough differentiation in terms of degree of difficulty and and pain. So like everybody needs payments, shockingly hard to do. That's sort of that perfect at the Venn diagram. Insurance is probably a decent example of that because insurance is way too complicated and like
And so, which is why I don't think that the only answer here is like, I want to find X for Y businesses. I want to do business in a box for this, and vertical software for this, and marketplace for this. I think we have to be looking beyond vertical and into other kind of indexed providers that can hit multiple categories simultaneously and benefit from some kind of portfolio effect across them. I think that's really important. That is honestly the strongest argument for the embedded story, is bet on multiple verticals simultaneously on the belief that every new company that gets started will get started on some kind of system of record, will be started with software as a core part of their operations. That's really the reason to make the embedded bet. And then you start thinking about what kinds and, what really matters to businesses and how could you build an embedded software company that really works. But the reason to do it is to take a very, very horizontal approach within the broad category of small business, rather than saying, I'm going to be a marketplace for this type of company.
So do you think that, and this is sort of like a little bit of a speculative macro question, but like, do you think that you'll see, if this works, do you think like the failure rate for new businesses in general will go down? Like, do you think this will make new businesses more likely to succeed?
Yes.
That's
interesting. I think you have to believe that. That has to be a key part of underwriting any one of these types of businesses. That are you bending the risk curve and the cost curve of entrepreneurship? If you're not, I think you have to be really have some really deep point of view on like what the point of that company even existing is. Fundamentally, the barriers to people starting businesses are things like, how do I get my first customers? I'm going to lose my health insurance. I don't know how to do the ops side of it. Like, it's lonely. There's a few like pretty common barriers to starting a company, even if it's a company of one, or maybe even especially if it's a company of one. It stands to reason that if you are going to meaningfully knock down one of those barriers, you will induce more demand for entrepreneurship or more supply of entrepreneurs. If you're not doing that, I kind of question how valuable your product is.
Yeah. Right. In other words, I guess you could, in theory, like make the universe bigger and just have the same, the failure rate be the same. But then why? It's interesting. Like if at some level, like that is that, that success rates will go up.
Failure rate goes down, but the raw number of successes goes up or something.
So it's interesting to me that like, you're in the capital markets business. Like, why isn't risk capital or lending a bigger part of, right?
It's
bigger part of this?
Question. It used to be, and it should be, but it used to be that when, hey, you want to start Random Walk, and you need to buy your Random Walk laptop, and you need to buy your, there's no cost for Random Walk, but like, let's say that there is, time. You go and you get a loan, and it's from the banker who you've been doing business with, and your brother has been doing business with for 25 years, and they know you, and they underwrite you, and they write you a loan. It's personally guaranteed, and maybe the interest rate's kind of high, but like, you get a loan to start the business. That market just does not exist anymore today at all. Banks are not willing to extend credit. The only thing that we really have is the SBA loans, but by design or not, they're not really used to start companies. They're really used to either add on to existing businesses or buy existing businesses. There absolutely should be a source of credit here. There should be a
banks
source
aren't stupid, right? Like they tend to underwrite, yeah.
Like these are so there's two things happening. One, some of this is a regulatory problem, which is that like regulators, a system is designed to do what it does. Regulators do not want banks making these loans because they are risky. Banks don't want to make these loans because they're expensive. It is expensive to underwrite these customers. Costs the same amount of money and time. Honestly, it might even cost more money and time to like underwrite Moses and Yoni, like Thought Boy Incorporated for $100,000.
Perfect.
As it does to underwrite, like a new location of Taco Bell. So,
and banks like known and legible. They like things that they've seen repeatedly and that fit inside a box, and like sort of their regulators.
I think anyone who can figure out how to extend credit profitably in this market will do well. And like we've certainly seen some ideas basically where things function almost as a mix of credit and equity. But I think it's a real problem. Now, the countervailing force to that is there's now also quite a lot of businesses getting started and that can be started that, they require income replacement, but they don't really require, there's no hard assets. They don't require office space. They don't require the same capital as starting, a Main Street shoe store in 1955. So while we've lost quite a lot of credit and capital in the market, we've gained a lot of new opportunity for extremely capital light businesses. All kidding aside about like, Random Walk not needing capital to get started. Random Walk didn't need capital to get started. Like you started a business and you didn't need, the bank wouldn't give you money, but you also didn't need it to.
Right, but I still like, and in some ways, like when I think through the things that you're, where the value is, it's like, what are the parts of the business that do, where operating leverage would be helpful, that sort of sit a little bit outside of the core expertise, and those things do require, you have to pay people, right? If you can't do them yourself, and like, so there is a bit of a chicken and egg thing where it's like, to get in this business, I might need ops and back office. But in order to pay my ops and back office, I got to be generating revenue. So like, how do you get started?
One beautiful answer on that is like, basically, can you structure it as a royalty? So if I'm willing to do ops and back office for 100 people simultaneously, and I do it on a revenue share royalty basis, then like your upfront cost to start just drops even more, maybe to zero. And we're seeing a number of companies doing some version.
Like, can you give an example?
Sure. So we're investors in a company called Chapter One, and Chapter One is doing exactly that for home services. So they basically go to people who like are currently working somewhere else, maybe, hey, I'm an exterminator working at, a pest control company, and I want to go on my own. Like, I don't super duper know how to find customers, and I don't like have the ability to pay someone to do the back office. Okay, great. We'll take a royalty on the business. We'll do the back office for you, and we'll help you go and get your customers.
And I guess, I mean, don't those businesses run a little bit of the, the Substack churn risk that once they get big enough, then then they'll want to kick the or is it like a perpetual royalty?
I mean, yes and yes. I think you have to be doing something that you have to be delivering a like high quality enough owner and operator experience that they're not going to want to churn. It has to be a trade where they get more than they give. And the way Substack tries to answer that is with the reader network. I don't know how well that performs for you and converts into paying readers. My guess is it probably converts into some good number of reader. Maybe down the line they convert to it's kind of fuzzy. Like, if you're consistently in the business of, this is something I stress with founders all the time, is the end customers are going to churn for a bunch of like natural and like positive reasons. If you're in the business of, hey, we support a bunch of, therapists or nutritionists, like people do a fixed number of visits and then they churn. That's fine. It's not a problem. So, but if you're consistently in the business of finding them new demand or connecting them with new demand, then they are not going to churn. I think that's probably the problem at Substack, is the way that they find demand is like fairly flimsy.
Yeah. Yeah. Do you think that there could ever be a business that was like VC in a box? Like, that's another industry that, people want to get into.
Yeah, totally. I mean, look, it already exists in hedge fund land, and there's no reason to think, I mean, that's effectively what the multi-manager hedge funds and pod shops are. There's no reason to think that venture isn't going to go that way to some extent. So if you,
but in some ways, it's like a perfect example of the opposite, right? Because the reason that the pod shops exist is because they're enormous, like, returns to scale and having all that stuff in house, shared resources, shared research, shared compliance. But they're not. It's not like you could start I'm going to start the pod shop, SaaS tool, like go start your own hedge. Maybe that is what you think.
What you would do in venture is you would be a fund of funds that would say, like, for the people who we capitalize, we're going to be, also let you run off of like central, we're an RIA and we're going to let you run all of your operations off of our books. And, we'll do it for a lower management fee or something like that. That's how you would
It's like a fun admin business, kind of like.
Yeah, it would be a fund admin business married with an LP business, I think.
So why do you think that hasn't happened? Like, in some ways, like, as part of the piece of the question is like, you're seeing more consolidation rather than decentralization in the asset management business, not just in venture and private equity and hedge funds. And the big have gotten bigger and the small are really getting squeezed.
When you're doing a true commodity business, there are only economies of scale. Yeah. I mean, I think it will. I think what we have seen in asset management has been like a move to this increasingly bimodal world where you have huge, multi-manager pod shops, however you want to define it, they're like big asset management companies. And then these very small, whether it's hedge funds or venture funds, private equity funds, much smaller. In the extreme, it's like one dude day trading is on retirement fund, but like the $100 million hedge fund is sort of under the same auspices. It does seem increasingly clear that venture is going in that direction as well, where like there are going to be 5 or 10, maybe as many as 20, I don't know, like huge firms that manage billions of dollars and have, every business line. And then there's going to be a very, very large number of names managing quite small dollars, doing stuff that running strategies that don't scale.
Yeah, it's funny. It's like I'm almost imagining going back to the SMB hypothesis. You can imagine this like cycle where it's like, okay, everybody wants to start their own real business, so you build these really big, successful tech companies that help enable that. But on the other hand, you have private equity out there trying to buy real businesses. You roll them up into one.
Are we just sitting at the first stop of the assembly line for lower middle market?
Exactly. It's the circle of life for decentralization to consolidation of.
Yeah. Yeah,
It's not a
look,
bad
I think it's
outcome.
very possible. And we may be part of the bet that I'm making is that the whole economy is going to get more bimodal. And so, these really small businesses, if they are not if they're not empowered to stay independent, they will get swallowed up and be fed into that consolidation machine.
So if you want to hear more of this, you want to tell me why I'm wrong, or better yet, you want to tell me why I'm right, flattery will get you very far. Find me on the internet. I'm very easy to find and talk to.